This show is intended for general purposes only, as individual situations may vary. Statements made should not be relied upon as recommendations or solicitation. When discussed, past performance is no guarantee or indication of future results. Nelson Financial Planning offers securities through Nelson Ivest Brokerage Services, member FINRA, and SIPC.
Good Sunday morning. This is Bud Hettinger. Next on News Radio 93.1 WFLA, the longest-running radio show in Central Florida, Dollars and Cents, with my good friend Joel Garris from Nelson Financial Planning. You can call him at the office this week at 407-629-6477 to schedule your free consultation to discuss your retirement plans, or you can talk to him right now at 407-916-5400.
Well, good morning, ladies and gentlemen, and welcome to the program Dollars and Cents. My name is Joel Garris of Nelson Financial Planning, and for the next hour here on News Radio 93.1 WFLA, we'll talk about anything and everything that has anything to do with your dollars, helping you make sense out of all of those different decisions that you face. On tap today, we'll talk a little bit about avoiding probate and why that's important. We'll also hit Bitcoin. Bitcoin back in the paper again this past week, and a subject of conversation across many a bar stool. And then long-term care policies. Perhaps you've gotten one of these letters of late that basically say that they're going to raise your premium. Is that the insurance company picking on you, or is that something else? Well, we'll talk about all of that in addition to answer your calls here on the program. As our good friend Bud Hettinger aptly gave out at the beginning of the program, the numbers to call on in and be a part of the program to add perhaps your topic to that list of topics we're going to hit today. 407-916-5400, toll free 1-866-916-5400. And then, of course, if you're a little shy and don't want to get on the air, you can always send us an email. That email is my first name, Joel, Joel, at NelsonFinancialPlanning.com. So that's how you can add your topic to the conversation today. Before we get into our other topics, we'll, of course, talk a little bit about the week that was, or I guess the past few weeks that were. It seems that we've got pressure on interest rates to go down. The Federal Reserve continues. It's amazing the change since the beginning of the year in terms of the perception of what's going on economically. And not really this country, because when you look at the economic data with the low unemployment, low inflation, we're kind of in that warm porridge mode, not too hot, not too cold, but yet the rest of the world really does seem to be struggling in it. And at some point, it's hard to go against the flow. If everybody else in the world, all the other central banks, like the European central banks, the Bank of Japan, and the like, are basically still cutting rates or doing things to help keep their interest rates low, it's very hard to find us on the increasing side of things. And so what you worry about there is if the rest of the world is not on as good a footing as you are, that perhaps you might wind up sliding down as a result of the poor economic conditions in other places around the world. So what happened at the beginning of January is that the Fed basically kind of started to change its tune. And, of course, the markets and the financial institutions and the like certainly do like lower interest rates, because that means that your cost of borrowing is lower. And unfortunately, those folks, the financial institutions and the like, have a greater force, I guess, in the marketplace than the individual savers that are out there. It seemed like There was a time not too long ago, a few weeks or so ago, where you were starting to actually see yields on things like money markets and savings accounts and the like start to approach 2%. Maybe you could find something that was over 2%. But unfortunately, with kind of this change of perspective, lo and behold, those interest rates have kind of trickled back down from that high point of a few weeks ago. So unfortunately, bad news for savers, folks that are socking money away in things like CDs and savings accounts and the like. Good news for financial institutions, especially with interest rates as low as they are. So at the end of the day, what that means is that the market continues to applaud that. And we've seen the market not over the course of the past few weeks, because obviously the market has gone on a pretty decent upswing, over 7% within the past 3 weeks or so. But more importantly, if you take a step back and look at what it has done so far this year, and specifically the day before Christmas when the market sort of bottomed out on December 24, the overall markets are up about 25%. Now, if you had told me on Christmas Day that 6 months later the markets would be up 25% from where they were, I probably would have had a hard time believing you. I also wouldn't have taken your call because I was celebrating Christmas with my family. But that has been a significant turnabout just simply as a result of the shift of interest rates. And once again, this past week, the Federal Reserve continues to continue that peel back, if you will, of their perspective of, we're raising rates. Remember, in December, they raised rates. I mean, this is how quick this has occurred, this change of philosophy. In December, they raised rates. Now they're talking about a waiting and seeing, and perhaps we'll cut if things, if we see any data that suggests that we need to cut, like inflation or poorer economic conditions. So it's interesting how much that has changed, and correspondingly how much the market has gone up within such a short period of time. Once again, underscoring the thought that to achieve investment success over time requires you to be consistent. Because just like that, the market can move. And what's fascinating about this is you may not know that the market has moved up that much because it doesn't get that much attention. In May of this year, so this is all of going back to last month, the market was trending down, had a few bad weeks there in a row, and I was invited on different talk shows to talk about it, and my goodness, okay, a lot of hand-wringing and a lot of pulling in here. You would have thought that, the sky was falling and recession was imminent. And then my line goes dead. Nobody calls me when the market goes up to interview me on talk shows because they don't care. That's not news anymore. So perhaps you may not realize just how much the market has in fact gone up so far this year. Since that low point of December 24th, it's up 25%. That's a pretty strong move that really continues to underscore that fundamental investment theorem that says you just can't predict this, folks. And if you think you do, particularly if you look at the numbers from December, from that low point, and we've said this before on the program, December of last year was in fact one of the highest, I think it was actually the highest outflow of dollars from equity mutual funds. So people took a ton of money, the most ever money out of the stock market, out of diversified stock-oriented mutual funds, only to find out that over the next 6 months, it proceeded to go up by 25%. So if there's any lesson you can learn this morning, if you haven't learned it already, it's don't get too hung up on what's going on in the market during any particular day, month, week, year, or what have you. Remember, your investments are there to help you over an extended period of time. Average couple age 65, the odds are nearly 100% in today's world that one of you will see 85. That means that those assets have to do what they've got to do over the course of a 20-year period of time. That's not a short period of time. That's a long period of time. So be careful on that. Nothing underscores that point. It's very simply than what we have seen over the course of just this past 6 months. Speaking of things that we're seeing much more of, we've seen this now a couple of times over the course of the past couple of weeks. When we see that in the office, we think, this might be worth talking about on the radio program for all of our listeners to get some insight on. And so we're going to tackle our next topic in the next segment, and that is the increase of your long-term care premium. We've seen over the course of time where folks who own long-term care policies are getting letters that increase their premium, and not by a little bit. We're going to tell you what those letters are all about, and we're going to tell you the decisions that you'll need to make should you get one of those letters. We'll tackle that when we get back here on Dollars and Cents. This is Joel Garris of Nelson Financial Planning on News Radio 93.1 WFLA.
This is Bud Hedinger. You know, you can talk to Joel Garris of Nelson Financial Planning right now on Dollars and Cents about anything to do with your money by calling 407-916-5400. Give him a call. It's time to make sense of your dollars.
Welcome back to the program, ladies and gentlemen. Have you gotten one of these letters from your long-term care insurer? They are not good letters to get. I think in terms of the letters that you can get in your mail, they rank as second on the crappy list, only to a letter from the Internal Revenue Service, because the letter will not contain good news at all. And typically you're going to get these letters if you've had a long-term care policy for a while, because a lot of those long-term care policies that you've owned for a while, or that were issued back 8, 10, 12 years ago, had some incredible, just unbelievable Cadillac to the max benefit provisions. Oftentimes they had compound interest increases in the daily benefit. Oftentimes they had unlimited payout of benefits. Those were probably the two biggest elements of those policies versus the policies that issue out today. They curb the increase in that daily limit, and then they also set a certain period of time upon which they're going to pay. So let me take a step back and help explain those concepts that I've just talked about, because in order to understand them fully, you have to understand sort of how a long-term care policy works, right? So a long-term care policy is basically a policy that's going to pay for your long-term care, basically kind of like a nursing home. I mean, some of them have different features that will provide at different points of time, but let's just generally make it easy and talk about the fact that, hey, you're sitting in a nursing home, and this is an insurance policy that will basically cover the cost of that nursing home. And how they determine how much they're going to cover is that they have something typically described as an average daily rate. So they have a cost number in there that, okay, if you're sitting in a nursing home, this is the average daily rate that it is costing you. And what they would typically do on that is that they would then have an inflationary type of increase on that daily value. So let's say you bought the policy like 12 or 13 years ago, and at that point, the cost of nursing home care might have been only $100 a day. And you bought it with a 5% compound, which is much more powerful than a simple interest rate. A compound interest rate compounds onto itself. So every year it adds into the balance that you had at the end of the prior year versus a simple interest rate. It simply takes the interest rate and what you started with and just adds that static amount to the policy each and every year. But with a compound, it has the power of compounding and increases much, much faster. So now, because of that interest rate compound, usually the interest rate is not what you would typically think of as an inflationary type interest rate because healthcare costs are increasing at a much higher rate than regular inflation. So typically the policies would have a 5% or something along those lines type of compounding rate. And so what that meant is that the policy you got 12, 13 years ago was in fact now at $200 per day, so that the benefit has increased to cover the fact that the costs also are more in your typical nursing home on a daily basis. The other thing about these policies is that they typically, had, this is what happens when you wake up, you roll to the radio show, and you don't talk to anybody. You don't do any of those voice things that you're supposed to do when you get on the air, and you just go straight in cold. I should have done some voice exercises to get the voice working. Anyway, I digress. Fortunately, I got some coffee, which you're not supposed to have in the studio, but just don't tell anybody I'm drinking coffee here. Anyway, so then these policies had a period of time, which many of which back in the day were unlimited, meaning that they would pay you or they would pay for the cost of care on an unlimited basis. No matter how long you sat in that nursing home, that policy would pay that daily benefit. Well, as you might well imagine, with the costs of health care continuing to go up at a much higher rate, particularly in a nursing home, and people are living longer and living longer in those types of facilities, guess what? The numbers have become a disaster for the issuing company on a lot of those older policies. Just an outright disaster. And so consequently, what they are doing, and this is legal for them to do it, because that's always the first question when someone comes to me with these letters that says, well, wait a minute, how come they're changing how much I have to pay on this long-term care policy? Can they do that? Why are they picking on me? And the answer is they're certainly not picking on you, because that would be illegal, not allowed to do that. But what they can do is they can look at the group of people that are of a certain age or a certain gender and live in a certain location, meaning not just Orlando, but like a bigger location like Florida, and basically go to the state insurance commissioner and say, hey, we need to raise the premiums for this group of people, and oftentimes those increases are allowed, and in some states it can be much, much higher. For example, in Illinois, a lot of long-term care holders in the state of Illinois are facing premium increases of 70% this year, and then next year, year two, it'll be a 30% increase. So that's basically a 100% increase in the premium during the course of 2 years. Here in Florida, many people are facing like a 25% increase in the first year, and then a 20% or maybe a 15% increase in the second year. So not as bad as Illinois, but clearly if you've been paying your premium all along and all of a sudden you get a letter that says, hey, it's going to go up by 25%, it's going to go up by 15 to 20% next year, and there's nothing that prevents the insurance company from going back, in fact, every year to request an increase in that premium. Now, that should kind of surprise you a little bit. And at the end of the day, it does kind of bug me because, you know what? If I'm an insurance company and I create a policy and I issue out a policy, right? And you're faithfully paying that policy, it would certainly bug me, and it does, why the insurance company can turn around and push its poor decisions back onto you and make you pay more money than what you originally signed up to do. That's troubling. But if you sat down and read the fine print of your contract, which I suspect you didn't, they can. And they do. And that's what that letter is all about. Now, if you get one of those letters, what are your choices? Well, let's go back to sort of that description of that long-term care policy that we were talking about. We were talking about how much the daily benefit goes up and how long the period of payment or payout of the policy is. Those are the kind of the two crucial elements of it. The third element would be like an elimination period, meaning it doesn't kick in on day one. It might kick in 30 days later. It might kick in 60 days later. That's kind of the third element of it. So you look at those particular elements, and typically in these letters, you'll get an offer, right? Of, well, if you do this, you can keep your premium only going up by this, or if you do this, you'll keep your premium maybe the same, or if you do this, maybe you'll even be able to lower your premium. And so what they're doing there is they're just ultimately shifting or attacking those benefits that were simply too lucrative from their perspective that they can no longer afford. And so consequently, they are simply changing the terms of the deal. So one option may be to no longer have that daily benefit increase, cap it at the number that it is at now, and then it stays at that going forward. And then that helps them better calculate the risk and the payout that is associated with the contracts, the contracts as a whole. The other option is to, instead of having it pay out for the course of your lifetime, then you wind up having to accept those payments just over a certain period of time. Maybe it's 5 years, maybe it's 4 years, maybe it's 3 years. So when you get that letter, you need to look at it very carefully to kind of figure out, okay, what's the offer here on the table, and what are the implications of it? Because you're going to wind up having to do some horse trading of premium versus benefits. You're not going to be able to, unless you want to pay the much higher premium, and that's fine if you do, but be aware that it's maybe a losing proposition, because 3 years from now you may find that you get the same letter again and you're all right back to where you are started all over again. But the name of the game is to look at kind of what they're doing in terms of the interest rate and how much that daily benefit is going to not increase, or it's going to basically stay the same, and then to compare that versus the benefit period, the period of time in which they are going to only pay out the benefits. Is that 3 years, 4 years, 5 years? As you might well imagine, if it is 3 years, then you wind up saving more on the premium than, say, for example, if it is 5 years. We're going to slide to the break at this time. When we get back, I want to kind of wrap up this conversation on long-term care, and then we'll hit one of two topics, either the Bitcoin stuff or the estate planning, or, in fact, we'll take your topic simply by calling in at 407-916-5400, toll-free 866-916-5400. If you call in, you can add your topic as well here on Dollars and Cents. This is Joel Garris of Nelson Financial Planning, News Radio 93.1 WFLA.
This is Bud Hedinger. You know, you can talk to Joel Garris of Nelson Financial Planning right now on Dollars and Cents about anything to do with your money by calling 407-916-5400. Give him a call. It's time to make sense of your dollars.
Hey, welcome back to the program, Dollars and Cents here on News Radio 93.1 WFLA. On the program today, we're talking a little bit about interest rates and the economy, and lo and behold, we're now tackling long-term care, specifically the letters that a lot of folks have been getting here in Central Florida about the provisions that allow an insurance company to basically increase your rate if they do it as a whole for an entire group. Bottom line, if you get one of those letters, you really do need to pay attention to it, because you've got a decision that needs to be made there. And basically the trade-off starts to become how much your daily benefit is going to be going up going forward. Perhaps it's not going to be compounding at the same rate that it was. That's one way to help combat the increase in that premium that you're seeing in that communication from your insurer. The other way is to basically have a benefit period or an elimination period. A benefit period basically means that they're going to pay out over a 3-year, 4-year, 5-year period of time. So it's not unlimited. So that helps to cap that amount on the insurance company's side of things. The elimination period is another way to do that, where you would say, okay, I'm not going to rely on this policy to pay the first 30 days or the first 60 days or the first 90 days. And so consequently, that also helps to combat the cost. But bottom line, if you got a letter from the insurance company, from your long-term care insurance company, you've got to really pay attention to it and really sit down and to think it through as to what makes sense based upon what your income picture is and what your asset picture is. But we urge you to take a serious look at that. We're going to slide to the phones. We've got Kevin in Orlando who will get us kicked off. Hey, good morning, Kevin. How are you?
Hey, Joel. Thanks for taking my call. Enjoy your show. Listen to it quite often.
Well, thank you, sir. I appreciate it.
Let me ask you this. Last year, cash did better than the bonds because of the rising interest rates.
Right.
Now the Fed's saying they're going to lower interest rates, and I've been noticing. I've got a diversified, tried to like 70-30, but I've got more in cash than bonds. But I notice now the bonds are doing much better than my cash is doing. If you were me, would you start putting your money into the bonds, or are they as good as they're going to get right now?
Yeah, the lot of the that's a great question. A lot of the movement is bonds, as you may be aware of, Kevin, is that when interest rates go down, the price or the value of those bonds goes up. So a lot of what you're seeing in your bond funds, of course, is not some higher yield because yields are going down, but rather it's an appreciation in those bonds themselves. So that's kind of the inverse game that happens with bonds, and it only works when you're in that period of time where the market believes that you're going to see interest rates shift down, is where you start to see those bonds appreciate. So you may have seen perhaps your biggest move already in that, with simply that change of expectation from where we were at the beginning of the year, where we were shifted sort of from raising rates to all of a sudden we're now thinking about cutting rates. And then that's had that corresponding effect already on the bond fund. Kevin, let me ask you a question. In terms of those cash and bond assets, you mentioned some percentages. What's sort of the stock, the bond, and the cash percentages on your overall portfolio?
So I've got 70% stocks. I've got probably 20% international, 50% domestic, and then on the bonds I've got like 10% of probably 50% of that is foreign, and 50% of that is short term, and then I got the other 20% strictly in cash.
I'd say how old are you, Kevin?
55.
Okay.
One more year to retire, I hope.
Yeah, I'd say you're pretty close on that allocation. I mean, I is the stock side mostly large blue chip, or is it all kind of everything?
Most I'd say most of it's S&P, large cap growth, and then I've got probably 15% in small and medium caps. But
okay.
Most of it's large.
Okay, that's good, because I think as you get closer to retirement, that's something that we would advise people to do. Reduce down the small mid, beef up more the large. Simply less volatility with larger companies than there is with smaller companies. I think your international is probably about right at 20%. You've also got your bonds half and half, foreign and domestic as well. I would say you're pretty close. I don't know. I mean, I suppose you could argue, some of that 15 or that 20% that's in cash. Do you trim that down to 15%, slide another 5% over to the domestic bonds? I don't know that I feel that strongly about it. You're kind of chasing fractions of a point at this point. The other comment I might make is with a 20% cash side of things, Kevin, that does kind of keep the powder dry, if you will. And so if there is a wiggle or an event in the market, maybe you look at taking 5% of the cash and buying opportunistically with that. I certainly wouldn't have for you said you were 55?
Yes, sir.
I certainly wouldn't have an issue with a 55 being more along the lines of 75% on the stock side, 25% on the cash and bond side of things. So that might be also something to think about. But I think you're pretty close on that overall mix, Kevin. I wouldn't worry about that extra 5% that might be potentially more on the bond side versus the cash side. I'd say for now, with as much as the conversation and interest rates is dominating the headlines, that you're a little heavier on the cash side is perfectly fine.
Perfect. Thank you much, Joe. I appreciate your time.
Very good. I appreciate your call, and great question at all. Sounds like you're on a good track, so congratulations on that. We'll go next to Lynn. Hey, Lynn, good morning. How are you?
Good morning. I'm fine. I have a question that I may have misunderstood. It's a little off the topic of interest rates. But on one of your programs in April, I thought I heard, or I may have misheard, that for a person that, regarding a required minimum distribution,
right,
that required minimum distribution could be reduced by an amount of a charitable contribution.
Yes.
Even for someone that does takes a standard deduction. My question then, if that's true, which is great, I didn't know that, or no one else can confirm it. How does the IRS understand? What do I? How
do you report it? Yeah.
It's not gonna match with the 1099 or whatever.
It does not. It does not. It does not. You're absolutely right. It does not. So what you have to do is you have to report the gross amount, right. And I used to know the number on the old tax form. It was line 15, but on the new one, I haven't worked with it. I mean, it's only been 1 year, so I forget the number. But you put the gross amount in, and then you slide over to the taxable amount, and the taxable amount is going to be less as a result of that qualified charitable distribution. And then what you put on your tax return is the letters Q, C, D. That's that must go on the return right on that line in order to notify the IRS, hey, okay, this isn't the full amount, okay, that you guys got the copy of on, but it's got to be a notified to the IRS, and how you notify them is that is the initials QCD that you would put on the tax return.
So I don't have to necessarily, for example, my church will give me an end-of-the-year contribution sheet that gives me a total. I don't have to show proof yet to the IRS that I've made this charitable contribution. I can just put the QCD on the line and reduce it by the amount of the contribution.
Correct.
Excellent. That's excellent.
Yeah, it really is. And the neat thing about it, Lynn, is, and I think we're going to hear a lot more about it going forward, or we should, because to your point, is this is a top line deduction that you're able to get regardless of whether you get to the deductions of being able to itemize or simply take the standard deduction. This is a very powerful technique for anybody that's charitable minded that allows them to reduce their income regardless of whether they're having to itemize. And a lot less people are itemizing now than they used to with that higher standard deduction.
Sure, it's excellent. I kept forgetting about it, and I kept wanting to call in, and now I remember, and then I'd forget. So today I remembered, and I'm glad I called, and I appreciate the information.
My pleasure, Lynn. Now, be aware that there is some particulars to that, whereby you've got to have your IRA custodian be the one to write the check to the charity. You cannot have the money come to you and then you write the check. You've got to do the paperwork directly with the IRA custodian that says, please send X number of dollars to my church. And what they'll do is they'll send you the check so that then you can at least hand the check to the church. But that check has got to be made payable directly to the church. That's the only little twist to it, Lynn, that you've got to make sure that you observe on it.
All right. That stymies it a little bit. I really appreciate the information. Thank you very much.
All right. Sounds good, Lynn. And we will slide to a break. So when we get back from the break, we'll continue the conversation here on Dollars and Cents. This is Joel Garris of Nelson Financial Planning here on News Radio 93.1 WFLA.
This is Bud Hedinger. You know, you can talk to Joel Garris of Nelson Financial Planning right now on Dollars and Cents about anything to do with your money by calling 407-916-5400. Give him a call. It's time to make sense of your dollars.
Hey, welcome back to the program, ladies and gentlemen. Dollars and Cents here on News Radio 93.1 WFLA. The numbers to call on in and be a part of the program, 407-916-5400. Toll free, 1-866-916-5400. Those are the numbers to call on in and be a part of the program. Or you can send us an email at joel@nelsonfinancialplanning.com. Those are the ways in which to get in touch with us. Certainly, Kevin and Lynn added some good topics to the conversation that we're having on the program today. Good conversation about bonds and the role in one's portfolio and the proper allocation. That's always a great topic on any conversation about your finances. And then Lynn talking about that qualified charitable distribution. That is a very powerful technique that has actually been around for about, I think it's about 3 years, maybe even a little bit longer than that. There was a period of time where it was around and it seemed like it wasn't going to be around because every year they had to kind of re-up it and renew it, or at least the folks in Congress had to do that. And then they kept doing that, but they wound up doing it so late in the year there for a couple of years where, you know, if you're doing it in December, it doesn't really help people plan much for that year. But now it is a permanent, or as permanent as the tax code can be, part, and so certainly a very powerful technique that, especially as people start to chew through their most recent tax return, which is the first one that had the higher standard deductions on it, they're certainly finding that much fewer people are, in fact, itemizing. And so what that means is if you want to get a tax benefit for those charitable contributions, then you have a great opportunity with the qualified charitable distribution. You do have to observe the parameters on it, the twist, if you will. particularly for a QCD, qualified charitable distribution, and that is that the check has got to be made payable to the charity by the IRA custodial institution. It can't come to you and then you write the check. It's not going to work that way. Unfortunately, I wish it would, but it does not. The IRS does want at least some control over it, and that's the control that they put in place. But, for example, if you're contributing to your church and you do so on a weekly or a monthly basis, perhaps the option in that case is to front load a quarter's contribution, and so you're doing that every 3 months, but you're front loading it so it's not like the church or the charity doesn't have that money to be able to work with and to meet its normal cash flow needs. So that QCD is certainly a very powerful incentive or option that folks have to be able to save some money on their taxes while continuing to make their normal contributions. Speaking of powerful, the cryptocurrency certainly started to dominate the headlines once again over the course of the past week. If you missed it, one of the big announcements this past week was the fact that Facebook was looking at developing a digital currency nicknamed or named Libra. It is expected to wind up being another version of a digital currency. It's funny. Last night we were talking a little bit with a good friend of mine who is a major leader in the local banking industry, and we got into this conversation, and you have to understand, kind of the allure of Bitcoin and the rest of cryptocurrencies is that it is not traceable as to really who the purchaser is and who the receiver is. And unfortunately, that lack of traceability is both its greatest interest and yet its greatest weakness, because one of the things that folks obviously look for is they want more privacy. I think there's a general trend out there about having a greater degree of privacy in one's transactions, which is where sort of the cryptocurrency market comes into play. The problem is that those types of individuals who really seek out privacy are not folks that you would want to bring home to your mother. And so consequently, the lack of being able to try and know who's on the other side of the equation winds up being its biggest weakness, because banking industry is highly regulated, and so it makes it very difficult to keep track of what you need to do in any banking relationship, which obviously is to verify who's giving the money and who's receiving the money. Anyway, we are out of time. My goodness, the hour went by quick today. So we'll talk more about the Bitcoin stuff, and we did not get to the estate planning probate stuff, so we got to get to that next week. So now you know what we're going to be talking about next week, a week ahead of time. We'll be out of here. Thanks for listening to the program. This has been Dollars and Cents with Joel Garris of Nelson Financial Planning, News Radio 93.1 WFLA.
This is Bud Hettinger, and you've been listening to Dollars and Cents with Joel Garris of Nelson Financial Planning. If you missed any part of today's show or want to listen to it again, check out the radio show at www.nelsonfinancialplanning.com or connect with them on Facebook or Twitter. Be sure to call Joel this week at 407-629-6477 to schedule your free consultation to discuss your retirement plan.
Fees, commissions, expenses, investment costs come in all shapes and sizes. Do you know how much your investments are really costing you? At Nelson Financial Planning, we believe that costs should be a major consideration in your financial plan. After all, the lower your costs are, the more you get to keep for yourself. This is Joel Garris, and I invite you to get educated about your investment costs. Visit nelsonfinancialplanning.com or call us today at 407-629-6477 to set up a personal conversation to review your investment costs. That's nelsonfinancialplanning.com or 407-629-6477 to set up that conversation.
A-plus Better Business Bureau accredited. Nelson Financial Planning offers securities through Nelson Ivest Brokerage Services. Member SIPC and FINRA. Listen to Joel Garris on Dollars and Cents every Sunday at 9 a.m. on News Radio 93.1 WFLA. This show is intended for general purposes only, as individual situations may vary. Statements made should not be relied upon as recommendations or solicitation. When discussed, past performance is no guarantee or indication of future results. Nelson Financial Planning offers securities through Nelson Ivest Brokerage Services, member FINRA, and SIPC.